Good morning, students. Welcome back to the session on advanced accounting. We started with accounting standards and we were discussing accounting standard 5. So today we'll continue with our discussion on AS5. Let's do a quick recap in terms of whatever we covered on this standard, and then we'll just quickly wrap up because only a small part of this standard is left now. This standard deals with net profit or loss for the period and certain items which are required to be presented separately in the statement of P&L particularly. So specifically we discussed about extraordinary items, exceptional items, and as regards both of these items, we understood that these have to be of significant amount. Secondly, as regards extraordinary items, which the standard covers, it has to be something which is not in the ordinary course of business. But as regards the exceptional items, which is something which is not covered by the standard, which comes out of the requirements of the Schedule 3, it was again about the items which are significant in nature, but those may be within the normal course of the business also, which was okay. Excuse me. Another category which we discussed and which happens to be very, very important and very, very practically relevant also, because you get to see those items quite significantly in the financial statements, and that happens to be the prior period items. Now, as regards prior period items, we discussed that these are those items which have impact on the P&L, or we can say which have material impact on the P&L. Number two, these impacts which arise during the year, they do not relate to the current year. They relate to the previous year or the previous years. And these impacts may arise because of certain errors, mistakes, frauds, or anything which got missed or which was intentionally not done in the previous years and which has been left, which is unrecorded. So idea was to record that in the current year, and that is what we call as prior period items. So very, very important point as regards the prior period items which you need to remember is that these prior period items could also be something which is unintentional. Okay, so if there is any clerical mistake because of which something could not get recorded in the previous year, that will also become a prior period item. Okay. Another aspect was around the accounting estimates. As around the accounting estimates, we understand that these accounting estimates are all approximations. They are not something which is going to be measured with certainty. So that's why some sort of judgment is involved, and that's why these estimates are subject to changes. And because these estimates are subject to changes, so that's why whenever such change will arise, that change will be required to be recorded prospectively and not retrospectively, for which we discussed depreciation. Depreciation change, if it arises because there's a change in the useful life, that will be considered to be a change in accounting estimate. Clear? Clear on this? Okay, now moving further, another point which we need to understand is around the accounting policy. So let's understand first of all about the accounting policy. You can also refer page 1.15 if you want. Accounting policy. Now, what is an accounting policy? We can say accounting policy is a norm, is a convention, is a practice through which an item gets recorded in the books of accounts or in the financial statements. These are practices which are developed by companies, industries over a period of time, and which are in line with the requirements of accounting standards only. Now, as regards the accounting policies, as we all understand, it's very, very important that they have to be consistently followed. Means year on year, accounting policy should be followed consistently. It should not happen that in a particular year we have one accounting policy, which is then changed to some other accounting policy. Then again next year we are making some changes in that accounting policy. Even if those changes are made, those are required to be backed up by some solid reason for making the changes. Maybe because of the law it is required to be changed, maybe the accounting standard has changed, or if there is something very, very important which significantly impacts the financial statements and which makes the financial statements more reliable for the users of the financial statements, only then it is required to be changed. Otherwise, we don't change the accounting policy. Now, for this, we can also take an example. Of say inventory valuation. Now, let's suppose a company is valuing its inventory on FIFO basis. Yeah, so that is the method they have been following. Now, if this company wants to change its accounting policy of valuation of inventory to, let's suppose, weighted average basis. Now it wants to change its accounting policy for valuation of inventory from FIFO to weighted average. Now this will be considered as a change in accounting policy. And whenever any change in accounting policy is done, so as we discussed, it has to be backed up by some solid reason. It cannot be given on an ad hoc basis. Means we can't just change it whenever it is considered appropriate by the management. There has to be a very, very significant rationale as not changing the accounting policy. And whenever such accounting policy is changed, the impact of such change is also required to be presented. It is also required to be disclosed in the financial statements. So as around these changes, there are certain points that we need to remember. First, this change is not a free will. Yeah, it's not a choice available to the company. It has to be considered, first of all, whether it is required for sure or not, only then it will be changed. Number one. Number two, whenever the change is made, impact has to be assessed. Impact has to be given in the financial statements, and a disclosure for the change is also required to be given in the financial statements. Clear on this? Clear on this? Now, as around this change in accounting policy, again a point which is important for us to understand is about a new accounting policy, because I've seen there's a lot of confusion as around this new accounting policy quite a few times. Let's understand this. Let's suppose a company has been dealing into a particular revenue stream. Okay, let's suppose they have got one revenue stream and they have been dealing into that for over years. Say in the current year, company has come up with a new revenue recognition stream. Yeah, new revenue stream they have started. Say in the current year. Now, because the company has started a new revenue stream in the current year, so what will happen? Company may also require to bring in a new accounting policy, yeah, or maybe certain language in the revenue recognition policy in respect of this second revenue stream which did not exist earlier. Now, because this transaction is new altogether, this did not exist earlier, this is coming for the first time. So that's why company will have to add some accounting policy. Now, can we say that when the company is adding an accounting policy, will be considered as a change in accounting policy in respect of revenue recognition? Because as regards revenue was there earlier, and revenue recognition was also done earlier. But can we say that this revenue recognition policy has now changed? The answer will be no. Why? Because as regards this revenue stream 1, the policy remains same. That has not changed. But because a new stream has come in, a new transaction has come in, for which we are required to draft a new accounting policy, cannot be considered to be a change in accounting policy. Clear on this? Yeah. Okay. So now, to discuss this, we can also pick up one illustration. Yes, so if you can all go to illustration number 4 on page 1.18. Illustration 4. Okay, Yash has a query. Yash is asking, sir, LIFO किसमें change होता है? So LIFO, you are talking about last in first out. Yeah, LIFO is not an accounting policy permitted under accounting standards. We have only FIFO or weighted average. LIFO is not available as an option. Okay. Then I think Pooja is asking for illustration number 5, but I can see only 4 illustrations. Maybe you're referring to some old material. Huh? Please refer to this new material only. Yeah. Okay. So let's go to this illustration number 4. Explain whether the following will constitute a change in accounting policy or not, as per AS 5. So first pointer. So we need to check whether this situation will result in change in accounting policy or not. Introduction of a formal retirement gratuity scheme by an employer in place of ad hoc ex gratia payments to employees on retirement. Tell me, over to you first of all. Tell me, what do you think? Should this be considered as a change in accounting policy or not? And please don't refer to the solution. Huh? Will you consider this as a change in accounting policy or not? Quickly. Yeah, I'm waiting for a response now. Jay is asking why LIFO is not allowed. See, only few options are allowed, so it's not something which is considered to be an appropriate valuation mechanism. That's why this is not allowed. Yes, quickly now. Okay, I think Pooja is asking for illustration number 5 of AS4. Let's discuss that towards the end of the session, please. Huh? Okay, so Sandeep and Harsh have answered. They are saying no, it's not a change. Can you also tell me the reason why this will not be a change in accounting policy? Okay, Siddharth is saying it is just change in the scheme and there is no accounting policy which is getting changed. Okay, so that's why it's not a change in accounting policy. Same is the response from Abhijit and Pooja. So, as regards this situation now, what do you see? we understand that a new scheme has been introduced. Okay, and some old scheme is removed. Yeah, so it's like a new scheme has been brought in. So as regards the old scheme, there might be an accounting policy, but because this transaction which the company has introduced is new altogether, so that's why what do you say? We will say that for this new transaction, definitely a new accounting policy will be required. But bringing a new accounting policy does not mean that we are changing old accounting policy, because this new accounting policy is in respect of new transaction which did not exist earlier. Clear? Clear on this? So this is not a change in accounting policy. Okay, next situation. Okay, I missed a lot of responses. And I can see all of you answered this correctly, except a few, and I'm hoping you would have understood. Okay, moving further on to the next situation. Management decided to pay pension to those employees who have retired after completing 5 years of service in the organization. Such employees will get pension of rupees 20,000 per month. Earlier, there was no such scheme of pension in the organization. So tell me, what do you think? Should this be considered to be a change in accounting policy or not? I think all of these responses are for the first one. Vishal, Fiza, Tulsi, they all answered. Ilaya, Hina, Nitya, Jay, Yash. Okay, great. So now I'm waiting for your response on this second situation. Okay, Abhinay is saying it's due to new scheme. I think Abhinay answered this one for the first one. I got this response now. Charu is asking if the new scheme is a replacement. Still, that will not be considered to be a change because this transaction did not exist earlier. Okay, Garisri is saying it's not a change in accounting policy. Can you also tell me again the reason why you're saying this is not a change in accounting policy? Inderpal is saying not a change. Fiza is saying not a change. Pooja Pradeep is saying not a change. Okay, Harsh and Vishal are also saying this is not a change. Now here again, what do you see? Here again we can see a new transaction has been introduced. Correct? So when there's a new transaction which did not exist earlier, we will need an accounting policy for this new transaction. Yes or no? And if we bring in a new accounting policy which did not exist earlier, can we say it's a change? No, it's not a change in accounting policy as per AS5. Clear on this? So this one is also not a change in accounting policy. Okay, clear? Okay, so then I can see same response from Sandeep and Ilaya. Very good. Okay, Pooja Pradeep and Tulsi have the same answers. Great. So with this, we come to an end to our discussion on this standard also. Again, it was a very, very small topic and hopefully an easier topic for you. So we'll now move on to the next standard. Just give me 1 minute. I'll just pick up the next standard now. Okay, so you can all move on to now page number 1.138, AS 29. Sandeep has a query. Sandeep is asking, sir, if earlier there was a scheme of pension, then what will be the treatment? That will again be dependent on the fact that this pension scheme, if that remains same. Okay, so if the scheme remains same, and for the same scheme, now the policy is getting changed, then it will be considered to be a change in accounting policy. So what is the change in accounting policy? That for the same set of transactions, we are now bringing new accounting policy. That's a change. If there's a new transaction altogether, and if we are bringing an accounting policy for the new transaction, then it's not a change. Yeah, because something which did not exist, how can we change it? We will only be able to change something which existed. Clear? Okay, so let's move on to this next topic, AS 29, which deals with provisions, contingent liabilities, contingent assets. See, as regards the standard, there are few things which are important for us to understand. First of all, we need to understand about provision and a liability. Okay. Now, what is a liability? I think all of us know about liability. So let's try to understand about liability once again. So liability, we can say, is a present obligation which arises due to past events arising from past events, correct, and the settlement of which is expected to result in outflow of the resources. Its settlement will result in outflow. Yeah, this is a liability. We all know about liability, correct? Now, as regards liability, if we take an example, so we can say, excuse me, sundry creditors can be an example of liability. Borrowings will again be an example of liability. Okay, yeah, these are examples of liability. Now let's try to talk about provision and will also try to compare this provision with a liability. Now, what is a provision? Provision is again a liability. So that means provision is something which is also a present obligation. Provision is something which will arise due to the past events, and provision will also result in outflow of resources. Yeah, but the only thing is, in respect of provision, we are not sure as around the settlement in terms of its timing, in terms of the amount which is involved. So that's why, what do we say? When this liability, as regards its settlement, in terms of amount, in terms of its timing, is not something which is certain at this point of time. Yeah, for which we need to make some approximation. That is when this liability takes the shape of a provision. So we can say, wherein substantial degree of estimation is involved. And what is the most important point? Estimation. Because estimates we have already discussed. What do you mean by estimate? Something which is not 100% accurate. Correct? Something which is not 100% accurate. That is an estimate. Yeah? So as regards liability, we need to understand that this is not something which is 100% accurate. Okay? So now, for a liability, we know what's the meaning. For a provision, we understand how is a provision different from a liability. Can you give me some examples of provisions? Yes, over to you. Can you give me some examples of provisions? Quickly, over to you. Can you give me some examples of provisions? Yes, waiting for a response. Huh? Vikas is asking, sir, what do you mean by substantial degree? You can say significant estimate is involved. Means we will have to apply this degree of approximation. We will have to estimate that, and this estimation will be significant. This is not something which can be done with 100% accuracy. Okay, that's the meaning. Siddharth is saying reserve for bad and doubtful debts. What about others? Then I can see a lot of your responses, and most of you are saying provision for bad debts. Some of you are saying provision for tax. Some of you are also saying provision for depreciation. Okay. Pratiksha is saying it's GST. Okay, Abhinay is saying provision for depreciation. Provision for tax is what Vivek is saying. Neha is saying provision for discount. Okay. Tulsi is saying provision for tax. And I can see a lot of your responses. Charu, Vivek, Preksha, Hina, Brinda. Very good. Okay. So I think you seem to have understood this point well, that it's a provision. And if it's a provision, then definitely some sort of estimate is involved. And this is not something in the nature of liability which is certain at this point of time. Yeah. But at the same point, what you also need to remember is that we need to differentiate provision from any other asset or liability. Okay. So for example, if you talk about provision for depreciation. Yeah. What is a provision for depreciation? Provision for depreciation is an estimate, but depreciation is something which we consider under which standard? AS 10. That is not something which you will consider under AS 29. Yeah. When it comes to provision for tax, provision for tax again is a provision which you make on an estimation basis at times. But there again, you can compute that with reasonable accuracy. Okay. So now the point remains, some of the situations wherein even if we try, we cannot compute the amount with 100% accuracy. Yes, we need to get on to those items which cannot be computed with 100% accuracy. Now, what are those items? Now, as around those items, we need to just check wherever we are ascertaining an amount, and that amount will result in outflow, and because that is an outflow, so that's why we are now not sure either in terms of its timing, means when it is going to be paid, or in terms of the amount, means whether it will be 1 lakh rupees or say 90,000 rupees or 1,10,000 rupees. Yeah, because this can vary. That is what will make that liability as a provision. Clear? Clear on this? We will pick up some more examples around both of them as we move further. Okay. Now, as around provision, there is one more aspect which we need to consider. If you can go to next page, you can see the definition of provision. Now, when do you recognize a provision? When there is a present obligation. Correct? And that present obligation results in a situation through which outflow of resources will happen, and that is probable. Now, this is a very, very important point. So what I am trying to do now is, I am just shifting from this difference of liability and provision to only provision. So I'll just take away this point. Okay, so now as around this provision, we are saying first of all there has to be a present obligation. Secondly, it should result from the past events. Third thing, it will result in outflow of resources. Okay, there's no doubt that estimation is involved, so we'll just keep this in mind that yes, estimation is involved. But whether the estimation is involved or not, one thing is for sure. What is that? Outflow of resources is going to happen. So it is probable. It is probable that outflow of resources will happen. Whether we will end up paying 90,000 or 1 lakh is not sure. That's why we are saying it's an estimate. But one thing is for sure, that either 90,000 or 1 lakh will have to be paid. There's no doubt about it. Okay. Number two, whether that 90,000 or 1 lakh will be paid after 1 month or 1.5 months is not sure. But this is for sure that this amount will be paid. Means there is a probability. There is a probability as around outflow of resources. Now it is very, very important to understand the meaning of probable here. What do you mean by probable? Probable means something which is more likely than not going to happen. Yeah. Or you can say something which has more than 50% chances of occurrence. Now, what is that more than 50% is not something which is defined. This is very judgmental. Maybe there's a chance of outflow which can be ascertained with 90% accuracy, or maybe with 80% accuracy, or maybe with 70% accuracy, maybe with 95% accuracy. It's all probable. So what do you mean by probable? More likely than not it's going to happen. Clear on this? For this, we will also pick up one example. Say there's a company against which a tax litigation is going on. A tax litigation is going on against a company. And the company has disputed this amount. Okay. But as regards its outcome, there is probability that the company will lose this case. Okay. So now there's a probability. What is the probability? That company will lose the case. In such a scenario, what do we say? We say that it's probable. Why? Because there are more than 50% chances that the company will lose the case. So when there is a more than 50% chance that the company will lose the case, so what should the company do? Company should create a provision. Company should therefore create a provision. Creating a provision means recognizing the provision in the financial statements, in the books of accounts, in respect of the amount which the company will be required to pay as against this litigation. Let's suppose this amount is rupees 1 crore. Okay, clear on this point? Clear on the meaning of provision? What do you mean by provision? Yeah? Any questions? Okay, so I can see some of your queries. Vrinda is asking, sir, provision for depreciation is a temporary amount. That's why I said there's something which is covered by other standard. We should not really pick this one as part of AS 29. Vivek is asking, sir, can we create provision for contingent liabilities? What do you mean by present obligation? Present obligation means today there's an obligation. Okay, we assess that obligation today. And as around provision for contingent liabilities, let's wait. For contingent liabilities, let's have a discussion. Then I think your query will automatically get resolved. Okay. Jay is asking, outflow of resources includes only cash or something else is also included? See, as regards the company, when we talk about outflow of resources, then definitely in terms of outflow of resources, this has to be the cash or bank. Yeah, means the company will be required to make the payment. Okay, clear on this? Yeah, perfect. So now, as around this provision, we have understood what do you mean by this provision and how this provision is required to be captured. Okay, let's now move further to the next sort of situation. Let me just take you to that situation now. Contingent liability. Now we'll do the similar sort of thing. We'll now compare this provision with the contingent liability. Please remember, we compared first of all provision with a liability, and that is why we got some clarity as to how this provision is different from a liability. So now it's important for you to do this comparison of provision with a contingent liability. So what is a contingent liability? So now we are saying once again, there's a possible obligation or a present obligation. Okay, so there's again an obligation which arises from past events. Once again, it's the same thing which arises from past events. So this second point remains same. And existence of which will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events. Okay, or we can say a present obligation that arises from past events, which is something which is not probable. Yeah. So now, as around contingent liability, this point changes to possible. I need your attention now, because this may be slightly confusing to some of you. See, in case of a provision, what did we say? In case of a provision, we said that outflow of resources will happen, and it's probable that outflow of resources will happen. But now we are saying that outflow of resources will happen And as regards those outflow of resources, it's not probable, it's only possible. Okay, it's not probable, it's possible. Now this probability has changed to possibility. So what does it mean? How is it different from probable? Possibility means, or possible means, a situation of 50-50. It may or may not happen. Unlike what we saw in case of probable. In case of probable, we were more clear. Yeah, there was more surety as around the occurrence of this event. But now we are not sure. It's only 50-50. If we pick up our same example, wherein there was a tax litigation against the company, if the company assesses that as regards the outcome of the case, company may win or lose, it's only 50-50. Means there are 50% chances of winning the case, 50% chances of losing the case. Then what do we call it as? Possible, or a scenario of a possibility. Then the probability goes away. Okay, then the probability goes away. Probability is not there. And in such a situation, wherein this probability goes away, what do? Instead of creating a provision, we will get into a contingent liability by giving a disclosure in the financial statements. Yeah, so whenever this probability is missing and there is only a possibility, so what do? We will disclose a contingent liability. We will not create a provision. We will not recognize a provision. Okay. So let's now once again understand this entire concept with the help of PPR analysis. And then I think you will get the best clarity of this concept. So there is a concept as per the standard which we need to follow. PPR. What do you mean by PPR? Probable, possible, remote. Okay. And let me just take one example to discuss this. So there's a company against which a litigation is going on. Company against which a litigation is going on. If there are more than 50% chances of company losing the case, more than 50% chances of company losing the case, then what will the company do? Company will create a provision in respect of that outflow. So in this case, provision will be created. If the company will say that it's only less than 50% chance, chances of losing the case are less than 50%, then it will become a remote. If the company says that the company is not sure, means 50% chances are there company will win and 50% chances are there company may lose. So if the company is into a situation of 50-50, then instead of creating a provision, what will the company do? company will create a contingent liability. And in case there are less than 50% chances, then what will the company do? Company will not do anything. Nothing will be required in the books of accounts. Nothing will be required in the financial statements. Okay. No contingent liability, no provision. This will not get recorded in the financial statements. And is there any logic in recording this in the financial statements? No. Why? Because if the company is sure of winning the case, then what is the point of recording anything in terms of liability in the financial statements? Yes or no? Yeah. Now, next point. For a provision, what do we understand? Provision gets recorded in the financial statements. Provision gets recognized. It is accounted for in the books of accounts. But a contingent liability is not recognized. It is only disclosed. Now this is again very important, because I remember a query came wherein you asked me, sir, how do we create provision for contingent liability? So I'm hoping you are now clear that provision and contingent liability are two different things. So there's no provision for contingent liability. There's no concept as such of provision for contingent liability. Okay. Secondly, provision will get recorded in the financial statements, but contingent liability will not be recorded. Means it will not be recognized. There will only be a disclosure of contingent liability in the financial statements, in the notes to accounts. Means contingent liability will not result into any asset or liability. Provision will result into a recognition of a kind of liability. Correct? And as regards this remote, we understood there's nothing in this, so that's why nothing will be required to be done over here. Okay, clear? Now, before we move further, let us get into your queries quickly. If you have any questions, any doubts around this, please let me know. Priya is asking, sir, if this provision is a kind of adjusting events, then can it be recorded? See, there again, you need to be very clear. If it is adjusting event, then you will follow a different standard. But as regard that adjusting event, you will have to check whether it is probable, possible, or remote. If it's probable, you will create a provision. Okay. Tulsi is saying, sir, litigation means I'm still not clear on this. Litigation means there's a dispute. So let's suppose income tax has raised a demand. Okay, and company is disputing it. So company went into a litigation. So therein the company is analyzing now as around this litigation whether the company will lose this case or win this case. That is what we call as litigation. Srishti is asking, so that depends on happening or non-happening of an event? Yes, in this case. So possibility is that sort of situation wherein we are not sure whether this will happen or not. That's why we are saying 50% chances are. It's 50-50 scenario. Rakesh is asking, sir, is the future legal expense a kind of provision? No, we are not talking about future expenses. We are talking about those expenses for which there is a present obligation. What do you mean by present obligation? Means there is an obligation today. In respect of future expenses, obligation is not there today. Obligation will rise in future. Clear? Then I think Pooja is clear on this. What about others? Any questions, any doubts in case you have? Sharon is also clear on this. Okay, great. Puja Pradeep is clear on this. If you want, you can also note it down. And I think this is also very nicely explained in the study material. So you can also follow this chart, flow chart on page number 1.143. On page number 1.143. Yeah. So as around the standard AS29, you can say this is the significant chunk. This is the most important part. Yeah. So this part which we have just discussed largely covers the standard. You can say broadly we have completed the standard. There are a few more things which we are going to discuss. We are not done with the standard, but the significant part of the standard is around this. And there's also a flowchart which is available on page 1.143. You can just refer this. It's very nicely captured and it summarizes this standard. Okay, Siddharth is asking, so the contingent liabilities are only disclosed in the footnote, not in the footnote, but in the notes to accounts. Okay. Ria is asking, this PPR analysis is clear. It's a small thing. Yes, it's a small thing. And as I told you, these are all small standards and very, very simple. In fact, as I just told you, this PPR analysis happens to be the significant part of the standard. Okay, Pratibha is also clear on this. Sandeep has understood. Great. Any questions? Then we'll move on to some illustrations. Dorji is asking, sir, explain reliable obligation once. See, there's nothing which is reliable obligation. Obligation means an obligation. And obligation means today we are required to pay something. That is what we ascertain on the basis of our commitment with the other party or transaction with the other party. Yeah. Jay, I think as around this examination, we can have a discussion separately. Okay, Fiza is also clear. Great. So then I think we can move on to one illustration now. Illustration 1 on page number 1.149. Okay, yeah, illustration 1, please. As at the end of financial year ending 31st December 2000x1, a company finds that there are 20 lawsuits outstanding which have not been settled till the date of approval of accounts by the board of directors. The outcome as estimated by the board is as follows. Yeah. So there are total 20 cases which are going on. In respect of 5 cases, there's 100% probability of win. Probability is 100% to win. For the next 10 cases, there are 50% chances of winning and 50% chances of losing. Okay. For the next 10 cases, there are 50% chances of winning, 50% chances of losing, and as around the losing, as around this chance of 50% of losing, the amount is also given. So if we lose, then there's a 40% chance of paying 1,20,000, 10% chance of paying 2 lakh. Yeah, and 50% chance of winning. So if we win, we don't pay anything. So amount is 0. %, nil, 40% and 10%. Amounts are given. 1,20,000 and it's 2 lakh. Okay, this is on the next 10 cases. Now 5 more cases are here. Next 5 cases. Okay, 1 to 5, then you can say 6 to 15, then we have 16 to 20. Here again, there are 50% chances of winning, 50% chances of losing. So if we win, we don't pay anything. But if we lose, then 30% chances are we pay 1 lakh and 20% chances are we pay 2,10,000. Okay, yeah. Outcome of each case is to be taken as a separate entity. So you can just say that even though these are clubbed together, this outcome is for one case. So that means for 10 cases, this will be amount multiplied by 10. Same is the case over here. So you are required to ascertain the amount of contingent loss and the accounting treatment in respect thereof, if any. Yes, quickly, over to you. So I think you need to solve this first of all, and then we'll get on to the solution. Quickly, over to you. I think Pooja Pradeep has solved this. She's saying first 5 we need to ignore completely. Next 10 there will be a contingent liability for which only a disclosure will be given. Last 5 there will be a contingent liability, only disclosure will be given. But I think amounts are missing in her response. So can you get on to the amounts also, please? I think it's quite simple. Waiting for a response. Okay, then Gunjan has answered this. Gunjan is saying first 5 cases, nothing will be done. Okay, what about others? Okay, Ramakrishna has answered this. He's saying first 5, nothing will be done. 68,000. Here, 68,000 is the amount, and then I think next 10 he said 68,000, and next 5 he said 72,000 will be the impact. But whether we create contingent liability or we create a provision is not given up. Yes, I'm waiting for more responses on this. Then I think Pooja Pradeep has computed this now. Quickly on. Okay, so now Preksha has also answered. Preksha is saying first 5 we need to ignore, then next 10 68,000 and remaining 5 72,000 and show this as contingent liability. Very good. Harsh has the same answer. Then Srishti has answered this partly for first 5. Okay. Then Fiza is saying for 10 cases it's the contingent liability, for 5 again a contingent liability. Riya is saying 40% into 120. So I think she has shared the computation. Very good once again. Okay, so now let's understand this. As regards this situation, I think one thing on which we were very clear was around creation of a provision or doing nothing or about a contingent liability. So for this one, do we need to do anything? No. Why? Because chances of losing are remote. Yeah. So that's why nothing will be done over here. Yeah. For these 10 cases, there are 50% chances of winning and 50% chances of losing. Yeah. So do we need to create a provision? No. So what do we do? For these 10 cases, we will disclose a contingent liability. For these 5 cases, again, we have the same sort of situation. So here again, we will only disclose a contingent liability. So one thing is very clear, that only a disclosure of contingent liability will be given. Now comes the point that when this disclosure will be given, so what will be the amount in respect of these 10 cases and in respect of these 5 cases. So for this, we need to compute. So we understand there are 40% chances of paying 1,20,000. Yeah. So if we compute this, what do you get? You get 68,000. Yeah. And similarly, if you compute these two, what do you get? 72,000. Correct? But this 68,000 is only for one case. We have 10 cases. So what will it become? 68,000 into 10 plus 72,000 into 5. So what will be the total amount of contingent liability to be disclosed? 10,40,000. This will be the total amount of contingent liability to be disclosed. Clear? Clear on this? Yeah. Then I think many more responses have come. Gunjan has also answered the remaining part. Sonu has shared the same sort of response. Ramakrishna and Vishal has given this complete computation. Very good. Sonu is asking, sir, is there a need to create a provision for the first 5 cases because there are more than 50% chances, but please remember, more than 50% chances are there to win and not to lose. Understood? So that's why you will say it's remote. You will not create a provision. Yeah? Your point is valid. And this sort of confusion can arise in the exam also. So that's why please remember that when you are having more than 50% chances of winning, it's similar to a situation of remote. Okay. Clear? All right. So moving further on to this. Now, in respect of provision, I'll come back to this part of the provision now. See, even though we have computed provision or this contingent liability in a way, the standard also explains us as to how this provision is required to be measured or what will be the basis of measurement of provision whenever this provision has to be recognized. Standard says it has to be the best estimate wherein risks and uncertainties are required to be considered. It has to be the best estimate wherein risks and uncertainties are required to be considered by us. And we also need to consider the future events. Now for us, it's very, very easy to understand. Why? Because we understand that provision is what? An estimate. Yeah? Provision is what? An estimate. And for measurement of provision, some sort of judgment will be applied. Some mechanism will have to be found out through which this amount will be ascertained. And how do we ascertain the amount? We consider what is the uncertainty which is involved, what is the risk which is involved through which we are saying that it will result in outflow of resources, what is going to be that future event through which outflow of resource will happen. Yeah. So when there's a tax litigation, so we'll take cognizance of the risks which are attached to the tax case. There are uncertainties which are involved. So while going through the case, We will understand what all uncertainties are involved, what are the tax laws, what do they say, and we'll also be taking care of all the future events which may arise in respect of this litigation. And that is how we will estimate this amount. Correct? Correct? Yeah. Next, another thing which the standard says is in respect of reimbursements. In fact, for the reimbursement, you can also just look at this table on page 1.146. Now, this is slightly different from what we have discussed. Okay, so when we talk about reimbursements, please remember, now we are not talking about provision. Now we are not talking about contingent liability. We are talking about a separate sort of concept. Reimbursement is something which you can say we have spent and which is going to be received back to us. Correct? That is what we mean by reimbursement. Now the question arises as to how this reimbursement should be recorded. Okay, let's take a very simple example to understand the meaning of reimbursement first of all. Say if there is an employee of a company, he has spent an amount. Let's suppose he has spent rupees 1,000 on travel. So this employee has spent rupees 1,000 out of his pocket on travel. Now travel was related to business of the company. So that's why what will happen? This employee will get this money back from the company. Yeah, this employee will get the money back from the company. So first of all, it was an expense, or you can say he spent this amount, and then he will be reimbursed. So if you look at this employee, is there any impact on the employee because of this 1,000? No, there is no impact. Yeah. Why? Because whatever he spent, he got this money back from the company. And for the company, this rupees 1,000 will become an expense. Yeah. Clear? So now what do you understand by reimbursement? If there is a reimbursement, then the impact will not arise on the entity. So now let's understand certain situations in respect of reimbursement. With the help of this table, I am on to this table now on page number 1.146. Okay. First situation. Enterprise has no obligation for the part of expenditure to be reimbursed by the other party. Yeah. In this scenario, now what do? Obligation for the amount expected to be reimbursed remains with the entity, and it is virtually certain that reimbursement will be received if the enterprise settles the provision. The obligation for the amount expected to be received remains with the entity, and reimbursement is not virtually certain if the enterprise settles the provision. Okay. Now, as regards the first situation, now let's look at the first situation. On the leftmost part, we understand enterprise has no liability for the amount to be paid. Yeah. So in this case, when the entity doesn't have any obligation, is there any need to create a provision or to disclose? No, nothing will arise in this case. Situation number 2. Now we get on to situation number 2. Obligation for the amount expected to be reimbursed remains with the entity, and it is virtually certain. Virtually certain means there are good chances, 100% chances that the reimbursement will be received if the enterprise settles the provision. So enterprise will be required to pay something and then will get the reimbursement. In this case, what will happen? In this case, this reimbursement will be recorded as an asset. Because whenever the entity will spend an amount, what will it do? It will record it as a receivable. Why? Because entity is virtually certain that it will receive this amount. So this will be recognized. This reimbursement will be recognized as an asset. Okay. And this may be offset against the expense in the period. Here. But please remember, this asset cannot exceed the amount of liability. Now let's try to understand this with the help of an example. Say there is a company A Limited. Yeah. This company has spent an amount on behalf of its client. So this company is into consultancy, and this company is spending an amount or has spent an amount on behalf of his client. What is the arrangement? That whatever amount this company will spend, client will reimburse. Yeah, client will reimburse. So now, when the company will spend the amount, what should be the accounting entry if this reimbursement was not there? Expense debit to bank. Correct. Let's suppose this is 1,000. If this reimbursement was not a possibility, company would have recorded this as an expense. Correct? But now, when the company knows that this expense will be reimbursed by the client, so what should the company do? Company will now record a receivable of 1,000 and will reduce the amount of expense by 1,000. Correct? Yes or no? So company will not record the expense in a way. So the simple accounting entry which the company can pass will be what? Receivable debit to bank. Yeah. So the standard over here says that whenever we are virtually certain that the reimbursement will arise, then expense should be offset against this receivable amount. But this expense can be offset only to the extent the amount has been spent. Let's suppose if we are going to receive 1,100 for some reason, then this expense should be reversed only to the extent of 1,000. It cannot go beyond it. Correct? Clear on this? Third situation. The obligation for the amount expected to be reimbursed remains with the entity, and the reimbursement is not virtually certain. Okay, reimbursement is not virtually certain. So if it is not virtually certain, can we recognize this as an asset? The answer is no. But this expected reimbursement, even though it's not virtually certain, there is an expectation that reimbursement will arise. This should be disclosed in the financial statements. Okay, clear? Clear on this? Now, as around these provisions, because these provisions are only estimates, that's why whenever there is a change in provision, that should also be considered as a change in accounting estimate, which should be recognized prospectively. Okay, clear? Now, moving further on to contingent asset. So I think it's a very small point again, and before we go for the break, there's one more part of this standard around restructuring which we'll pick up after the break. But we can just quickly discuss one very small point of the standard which is related to contingent asset. And you can say this is somewhat similar to what we discussed in case of a contingent liability. Somewhat similar. Huh? Contingent asset. If you want, you can also refer page number 1.143. For a contingent liability, what did we discuss? When it is possible, when it's 50-50, okay, when it is uncertain as around the outflow, then instead of creating a provision, instead of recognizing it, we only disclose. Yeah. Similarly, there could be certain situations when the receivable is not virtually certain. Because if we are virtually certain in terms of receiving an amount, then what do? We record it and we record that as an asset. Because an asset can be recognized only when we are virtually certain. But if there is an uncertainty involved, if there is an uncertainty involved in respect of a receivable, similar to what we saw in case of contingent liability, then the standard suggests that we should give a disclosure of contingent asset. Now, as around the contingent asset, once again, please remember that contingent asset is not recognized in the financial statements. It is only disclosed, and this disclosure is also usually given in the board of directors report, or you can say the report of approving authority. So we are not talking about disclosure in the financial statements. We are only talking about disclosure in the report of approving authority. Yeah. And let's try to understand this concept of contingent asset with the help of an example. See, there was a company for which a tax litigation is going on. Yeah. Say at one level, at the first level, when the company was into litigation, company was not sure whether the company will win or lose. Okay, at that point of time, under protest, company had to deposit some amount. Generally, if you know about tax cases, companies are required to deposit some amount under dispute. Okay, so company deposited an amount under dispute. Yeah, and this was also recognized as expense. This was not recorded as asset, recognized as expense. Now, at the first level, company was not sure whether the company will win or lose. Its outcome was 50-50. So we are not talking about contingent liability now. So in that case, will the company do anything? Yes, contingent liability will be disclosed, which is done. Let's suppose at this level, the outcome was that company won the case. Company won the case. And the department now went to the higher level. Department went to the higher level, second level. Department went to the higher level. Now, as around this higher level, there again, we are not sure as around the outcome of this case. Can we be sure as around the outcome of this case? No. Till the kind case is going on, we are not sure whether the company will win or lose the case. But now, because the company has a precedence and the company also has a favorable judgment at a lower court, so that's why this can be a case wherein company can say the amount which it deposited and it expensed off will be possible in terms of its recovery. And that's why therein this contingent asset can be disclosed. It cannot be recognized. It can be disclosed. Clear? Clear? As to how this contingent asset sort of situation can arise. Clear on this? Yeah. Okay, so any questions, any doubts that you may have on this, please let me know. And then we'll take a break. Yeah. I think Chaitanya had a query. Chaitanya was asking, can we write cash debit on asset, please? Were you talking about the accounting entry we passed? When we debited the asset, then cash cannot arise. Why? Because it will be a receivable. It's not yet received. So that's why we are recording it as asset. Okay, Sakshi is asking, sir, please can you explain the example given on the page number 1.6 related to check? I think if that is related to some other topic, let's park it towards the end of our session, please. Okay, yeah. Okay, Charu is asking about this contingent asset situation once again. Sure. Let's understand this. See, in respect of a contingent asset, what are we saying? That it's an asset wherein we are not virtually certain in terms of the amount that we are going to receive. Means the amount will be received is not virtually certain. It's only possible. Yeah. So now at the first level, when the case litigation is going on, can we say that we have the possibility of the recovery of this amount? No. Therein to say the possibility is there will be difficult. Why? Because it's 50-50. We don't know whether the possibility exists or not. But If at first level company has won the case, then the possibility arises. So that's why when the department went on to the higher level against the company in terms of this litigation, even though it still remains 50-50 in terms of losing or winning, a contingent asset can be disclosed. Why? Because now there is a possibility in terms of recovery of this amount. So that's why we are saying now, having this decision in favor of the company at the first level, possibility has arisen, because of which this asset, even though it's not virtually certain, is definitely carrying a possibility in terms of its recovery. Clear now? Clear on this? Sonu, Ria, Gunjan, are you now clear on this? Charu, you are clear on this now? Quickly, please confirm. And as we discussed, contingent asset will only be disclosed. It cannot be recognized. The moment you recognize it, it will not remain a contingent asset. It will become an asset. Yeah, because what's an asset? Something which is virtually certain, which is probable. So that's why this has to be only disclosed. Yeah, Pooja is clear on this. What about others? You're clear? Okay, perfect. Sandeep is also clear on this. Great. So we can now take a break. Yeah, so let's take this break of 10 minutes, and after the break, we will continue with this topic. So we are not yet done with this standard. Some part of the standard is still left. So after the break, we'll complete this part. Okay. Yeah. Hi, welcome back. So we'll now continue with our discussion. Okay, so moving on to the next part, that is about restructuring. So what is restructuring? Let's try to understand and how this is really relevant in the context of our discussion and what is required to be done in terms of restructuring when it arises. So taking an example of a restructuring, first of all, say a company A Limited has got 3 plants. Plant 1, plant 2, plant 3. Okay, it has got 3 plants. Now this plant number 1 has been incurring losses. This has been incurring losses. Yeah. And because this has been incurring losses, so that's why the company plans to shut this plant. So company will continue with these 2 plants, but this plant will be shut down. Yeah. Now because this plant will be shut down, so what will happen? Certain liabilities may arise on the part of the company in respect of employees which are associated with this plant. Say 50 employees are working with the company who will not be able to continue, okay, or the company will not be able to continue with those 50 employees if this plant is shut, if the company discontinues this business line. Now when these 50 employees will be retrenched, certain liabilities may arise on the part of the company, which is then required to be recognized. So this is a kind of restructuring which organizations do. There could be various purposes of getting into a restructuring. Largely, it's towards the business objective of achieving good profits, of getting into a situation wherein company can look towards its long-term objectives. Okay, clear on this? Clear on the meaning of restructuring? Yeah? Clear on the meaning of restructuring? Quickly, please confirm. Clear on the meaning of restructuring? Perfect. So let's look at some examples of restructuring. Now, what do you mean by restructuring? And what are the examples? Sale or termination of a line of business, something which we just discussed. Say a company has been dealing into trading, company is also manufacturing those goods, and company has another segment into which it is dealing. Now the company wants to stop the manufacturing of those goods. It wants to only continue with the trading of those goods. So this is again what? Termination of a line of business. Closure of business locations in a country or region, or relocation of business activities from one country or one region. Say a company has been operating in northern India, western India, southern India, 3 regions. If you look at the business markets, and the company believes that the northern part is not profitable Company has not been able to make profits. Company has been incurring losses. So company wants to focus only on two markets and discontinue this northern market. Okay. Changes in the management structure. Many a times you get to hear about this, that a top company has changed its CEO, has changed its board of directors, has changed its CFO. Yeah, this is again a kind of restructuring which is done to achieve the larger objectives. Fundamental reorganizations that have a material effect on the nature and focus of the enterprise operations. Yeah. Now, as we discussed, these are the restructuring, and because of these restructuring, certain costs may be associated. Now the question arises, when should the restructuring costs be recorded? At what point of time restructuring costs should be recognized? Standard says restructuring costs should be recognized. Standard says restructuring costs should be recognized when it is binding. Only when it is binding on the part of the company. Say for example, if the company plans to sell its business line, so till the time it's not bound, means the management should have a firm plan. Management should have a firm plan to dispose of maybe a set of assets or to get away with that line of business. Yeah. Internal approvals should be in place. Internal approvals should be in place. If the board approval is required, that board approval should be in place. It should not be an idea, it should not be a thought, but the action towards this plan should be going on. So the required approvals should be in place. And when we talk about required approvals, we are talking about internal approvals. At least internally, management should be clear, firm in terms of getting ahead with these plans. Third, a formal communication should be done. Formal communication to those parties which will get impacted because of this restructuring should be done. So if the management plans to do away with, let's suppose, 50 employees, then a formal communication to those 50 employees in terms of their settlement, in terms of those employees moving away from the company should be done. Only and only when these conditions are satisfied, and all of these conditions are satisfied, the restructuring provision should be created, otherwise not. Okay, clear on this? Yeah. Only and only when all of these conditions are fulfilled, a restructuring provision should be created. Now, what will be the basis of creating that restructuring provision? That will remain same. Something we discussed in case of a provision, we need to estimate that. We need to estimate the outflow that will be involved. And once again, please remember that this is also going to be an estimate. This will not be an actual liability. Yeah, by actual liability means at this point of time when this entire plan is getting finalized, okay, and till the time this is not actually executed, maybe that this amount is not certain, but yes, with reasonable level of accuracy, this amount is required to be ascertained and provided for as a provision for restructuring in the books of accounts. Yeah, clear on this? Any questions, any doubts that we may have on this, please let me know. We will then move further. And we'll also pick up one example. Yes, any questions, any doubts? Charu is asking for example of reorganization. See, reorganization, you can say the management is not very satisfied with the outcome of its top organization. Okay, top level organization. So management wants to do away with the top level organization. Management plans to change the top level. Many times you get to hear this, that the top level has been changed, CEO has been changed, the managing director has been changed, yeah, the board of directors has been replaced. Many a times. Yes, any more questions? Okay, so Pooja is asking for the conditions. See, in terms of the conditions, we need to have 2 points in mind. First, management has to be firm in terms of getting ahead with this restructuring. By firm means management's internal approval should be in place, management's action plan should be on. Yeah, it should not be a thought, but an action plan should be there. Secondly, a formal communication to those parties which are going to get impacted because of this should be done. So these two are the most important points that you need to remember. Only when these two are done, provision for restructuring can be made. Otherwise, it will be more of a thought, which is more of an idea, which can keep changing. But till the time this is not finalized, this should not be considered as creating a provision. Okay, clear on this? Then I think we can move on to one example. In the meantime, if you have any queries, you may let me know. Yeah, any questions, any doubts? No? So let's move on to illustration number 2. Yeah, let's move on to illustration number 2. Ria is asking, sir, in the book, where are these conditions defined? So you can go to page number 1.148, you will get it. Huh? So this is something which is more descriptive given by me. You can just refer page number 1.148. Okay. Yeah, should we move further? Illustration number 2, please. Axox Limited is in the process of finalizing its accounts for the year ended 31st March X2. The company seeks your advice on the following matters. First, company's sales tax assessment. Company's sales tax assessment for the assessment year X1 X2 has been completed on 14th Feb 2000 X4 with a demand of 2.76 crore. The company paid the entire amount due under protest without prejudice to its right of appeal. The company files its appeal before the appellate authority, wherein the grounds of appeal cover tax on additions made in the assessment order for a sum of rupees 2.10 crore. So a demand of 2.76 has been raised company deposited this amount and this has been deposited under protest. Okay, and the company also went in for an appeal, and in the appeal the company has challenged an amount of rupees 2.10. So in this situation, what will be the accounting treatment? Over to you, quickly. Yes, what will be the accounting treatment? Quickly, please. What will be the accounting treatment? Over to you. Without reading the solution, please, you need to answer this. What will be the accounting treatment? Yes, waiting for a response. What will be the accounting treatment? Yes. Waiting for response, quickly. How will you deal with this in the books of accounts, in the financial statements? Harsh is saying 2.1 crore will be a possible obligation. So this will be a contingent liability. Yes, what about others? Yes, quickly. How will you treat this in the books of accounts? In the financial statements, what will be the treatment? Okay, great. So Khushi is saying this will be disclosed as a contingent liability. Can you tell me the amount, Khushi? Pooja is saying 2.10 crore will be a contingent liability. Okay. What about others? Okay. So Siddharth is saying 2.10 is contingent liability and 0.66 will be recorded in the books. But how is that recorded? Abhinay is saying 0.66 CR is contingent liability. Sonu is saying 2.10 is the restructuring cost. Okay. Ramakrishna is saying greater than 50% chances to wins. Hence, show this as a disclosure of contingent liability. 2.10 rest provision. Okay. So let's get on to the solution now. In this case, what has happened? There's a litigation against the company. The department has demanded an amount of 2.76 crore. Okay. Now, whenever the department demands, so the company is required to pay this. But when the payment is made, that is under protest. Under protest means company is protesting this amount, but the amount has been paid. Now, out of this 2.76 crore, company is protesting only 2.10. Why? Because the appeal is filed only in respect of this amount. So that means the other amount, 0.66, which the company has paid, company is not protesting that. Yeah, company is not protesting that. So that means company has accepted this demand, but the company is not ready to accept this much amount. So what will happen? This will be recognized as a provision. This will be recognized as a provision, and this will be shown as a contingent liability. Okay? Yeah. What is the accounting entry which the company will pass? So company will say loans and advances debit 2.76 to bank 2.76. Why will the company say loans and advances debit? Because the company has deposited this amount under protest. Under protest. So company will expect that this money will come back. Okay. Then, in respect of 0.66, company will have to record an expense. Expense debit 0.66 to provision 0.66. Yeah. So in the balance sheet, what will happen? An asset will be recorded. A provision will be recorded. And where will this 2.10 go? This will go to the notes to accounts. Will this come on the balance sheet? No. This is not recognized. This is only disclosed. Clear on this? Yeah? Riya, now you're clear on this? Charu, you're clear on this now? I think some of you didn't understand the question altogether. I think Siddharth answered the same thing which I have just given. Very good. And Dorji is also okay. Very good. Dorji had the same response. Khushi had the same response. Very good. And I think Preksha had the same response. Great. So Riya, if you can confirm, is this clear to you now? Quickly. And all of you, please confirm, is this now clear? Question is clear. Solution is also clear. Yes, tell me fast. Okay, great. Pooja is clear on this. Riya has not understood. So Riya, I would suggest you can just go through this slightly later, please. I'll just quickly, for a reference, tell you that there was a demand against the company, 2.76 crore, which the company paid. Okay, so this is the accounting entry which the company passed. And now, when the company has paid this demand, company is contesting only for 2.10. So where will it go? Contingent liability. And this amount which the company is not contesting, what will it become? It will become an expense for which provision will come. Okay. Now, moving on to the next situation, second point. The company has entered into a wage agreement. Company has entered into a wage agreement in May 2000 X2, whereby labor union has accepted a revision in wage from June 2000 X1. So we are looking at financial statements of 31st March X2. Yeah. And company entered into an agreement in May X2. Whereby the labor union has accepted a revision from June X1. So revision will be effective from this date. Revision will be effective from this date. The agreement provided that the hike till May X2 will not be paid to the employees, but will be settled at the time of retirement. So this hike, okay, this hike has two parts. First part is for the period June X1 to May X2. May X2 is when the agreement got signed. So May X2, it's been decided that for this period, this period, whatever is the hike that will not be paid to the employees now, that will be paid when they retire. It will be paid, but when they retire. And the other amount will be, which will come after May 2. Okay, so that will be the revised amount only, which will be paid to them on a monthly basis. The company agrees to deposit the arrears in government bonds by September X2. And the company has agreed that the arrear, now it's an arrear on the part of the company. For this period, whatever hike is payable to the employees, let's suppose the amount of hike is rupees 50 lakhs. Okay, let's suppose the amount of hike is rupees 50 lakhs. Yeah, this 50 lakhs will be payable by the company at the time of retirement. But company is saying that company will keep this money into a kind of investment in government bonds, and company will do that investment by September X2. Okay, so company will deposit this amount in government bonds. All right, clear? Now tell me, what should be the accounting treatment for this? Tell me, over to you. I'm hoping you have understood the question. I think Madhuli had a query. Madhuli was asking, sir, why we are considering 2.10 as contingent liability, because this is something which is under protest. There are chances of winning and losing. That's why. Yes. As around this second situation now, tell me, what is your answer? Yes, quickly, over to you. What should be the answer? Fast, please. How will you treat this in the financial statements? Okay, then I think Vinod has answered this. Vinod is saying wages to provisions. So this wage amount will be recorded as a provision and deposit to bank. And after May 22, wages will go to the bank. I'm not clear, Vinod, on your response, please. You can just clarify, maybe you can elaborate. Yes. Other students, if you can just respond quickly. I think it's a very, very simple one. Harsh is saying the whole amount of hike will be provided as provision because it will probably occur in future. Very good. Yeah, it's very simple. Today, it's been decided. What is decided? That the amount will be paid by them. So is there any doubt as around this payment of 50 lakhs? Not at all. Company has accepted this amount. This amount is definitely be paid, is going to be paid by the company. The only thing is this amount will be paid later on, not today. So how will the company record this? Company will record this as a provision. Clear? Clear on this? This amount will be recorded as a provision. Yeah? Clear? Perfect. Then I think I received this response from Vrinda as now the first situation now. Pooja is saying this area is recorded in the financial year X1, X2. Yes, that's correct as a provision. Okay, then I think Vrinda has a query. Vrinda is saying out of 2.76 crore in the first situation, we recorded, which was recorded as an asset, 0.66 has become expense. Yeah. Then the loan amount should also get deducted? No. See, in the balance sheet, full loan amount will be presented and full provision will also be presented. These two will not be net off till the time case is not settled. When the case will be settled, then the entire amount will be settled. Okay, then I can see a lot of responses around this second situation. Very good. AI is saying it's very simple, sir. Create a provision. Great. Ramakrishna is saying, oh, Ramakrishna, hoping now you're clear on this. Dorji is saying provision. Okay, and then I think Pooja has already answered this. Okay, great. So with this, we are done in relation to AS 29. And I think you don't have any questions for homework today. Yeah, so you don't have any questions for homework today, but you can also confirm whether you have completed your homework of the last session or not. Please confirm you have completed your homework. Yes. Please confirm whether you have completed your homework. Last session, few questions I gave you, whether you have completed that or not. Gunjan answered this. Then I think you had some doubts. So before we move on to the next topic, I think still some time is left. We can pick up another standard. But if you have got any questions, any doubts, which we park towards the end of the session, please let me know. We can quickly have a discussion on that. Harsh has completed this. Preksha is asking, sir, but won't it be recorded as outstanding since it is due on the part of the company? Yes, of course. So provision is outstanding only. We are not paying it through back. So provision is a liability. So this will remain outstanding only. Okay, Pooja is saying we can now pick up illustration number 5 of AS4 because otherwise my homework is completed. Okay, so let me just go to AS4 and what is there in illustration number 5. All right, quickly in the meantime, if all of you can confirm about your homework, please. Madhuli seems to have confirmed. Srishti is saying yes, it's done. Harsh has confirmed. Very good. What about others? Please confirm. In the meantime, I'm just going through this illustration number 5, which is page 1.9. This is AS4. Okay. AS4. Okay, so Sakina has completed, Ramakrishna has confirmed, Khushi, Charu, Diya, Riya, they have confirmed. Very good. Sandeep has also confirmed. Great. So let's go into this illustration quickly. A limited company closed its accounting year on 30th June and the accounts for that period were considered and approved by the board of directors on 20th August 2000X1. So it closed its accounting year on 30th June. Yeah. And the accounts for that period were considered and approved by the board on 20th August. That is when the board approved. Company was engaged in laying pipeline for an oil company deep beneath the earth. While doing the boring work, on 1st of September X1, that means after the board approval. After the board approval, it had met a rocky surface for which it estimated that there would be an extra cost to the tune of rupees 80 lakhs. So it found that 80 lakhs will be a cost for the work which has been going on. You are required to deal with this situation and state with reasons. Yeah, so for the financial statements, which is a year ended of 30th June X1. Please remember, in this case, year ended is slightly different. It's not 31st March, it's 30th June. Okay, Srishti, I'll come to your query. Quickly, please confirm, what will the answer? How will you deal with this? Yes, quickly. Yes, quickly, how will you deal with this? Can we say it's adjusting or non-adjusting event? It's none of them. Why? Because if we talk about adjusting or non-adjusting, both of those events occur between the balance sheet date and the date of approval. This is an event which is taking place after the date of approval. Standard doesn't cover this. Clear on this? Yeah? Outside the scope of the standard. Fine? Okay. Then I think we can next pick up illustration number 2 on page number 1.7. All right. I think we covered this, but not a problem. We can cover this again. Srishti is asking for this. Illustration 2. An earthquake destroyed a major warehouse of ACO. The accounting year of the company ended on 31st March. Earthquake occurred on 20th May. The accounts were approved on 30th June. That means earthquake occurred before the date of approval. The loss from earthquake is estimated at 30 lakhs. So I think we discussed about this. In this situation, is this an adjusting event? No, this is not an adjusting event. So the first answer is it's not an adjusting event. But the earthquake could have such an impact on the financial statements of a company by which its going concern assumption may become appropriate. And if that happens, then the financial statements for the year ended 31st March X2 will have to be prepared on a liquidation basis. As of now, from the question is not clear whether the going concern assumption is becoming inappropriate or not. So that's why you will have both the solutions in this case. Clear? What about others? I think all of you are clear on this. Great. Then I can see another query from Charu. Charu is saying, sir, can you clear again? Contingent asset is never recognized. See, please remember, when we say it's never recognized, it's only disclosed, means no accounting entry will be passed. As regards contingent liability, only a disclosure. Disclosure means in the notes to accounts, you will disclose that this much is the contingent liability. That's it. Similarly, for contingent assets, you will only give a disclosure in the board director, in the director's report. That will also not come in the financial statements. It will only go to the director's report. No accounting entry will be passed. That is what we mean by not recognizing and only disclosing. Fine. For better clarity, what I would suggest is you can also go through, what you can also do is you can just go through financial statements of any company. You will understand as to how the disclosures are given. Then I think Charu is talking about illustration number 2 of AS5. Illustration number 2. See, we didn't cover because this is your homework. So if you believe this is not covered and I didn't give you this one for your homework, you can mark it for your homework. Okay? Yeah. So with this, I think we can now conclude our discussion. I was planning to start another topic, but the time has not permitted us. So we can just end our discussion for today over here. So in the next session, we'll start with the new accounting standard. All right. Yeah. So thanks to all of you once again for your time today and for your wonderful participation. Sorry, Charu again has a query. But when to disclose contingent rent? I gave you one situation. When to disclose contingent rent? When there's a possibility that this will be received, but that possibility is not probability. Okay, yeah. This 50-50 chance that this amount will be received, it's not certain. Because the moment it becomes certain, it will be recognized as asset and not contingent asset. So contingent asset, you can say, is a diluted form of asset, which doesn't get recognized. Similar to what you see in case of contingent liability. Clear on this now? Yeah. Thanks to all of you once again. Thanks so much. Yes. Thank you.